There are so many things to talk about in Nigeria at this time. We talk about inflation, we talk about the poultry as we have seen there. We talk about security, and this after the declaration of the state of emergency on food security by the president. As some people say, well, we have heard that declaration, but what steps does it come with? How is the implementation of it? And all of this will feed into, the numbers that we see in the economy, the GDP, the inflation. We saw inflation jump at 22.7. And it's important to always note whenever we talk about the inflation numbers that the NBS itself, apart from the fact that it was lower than economists' expectation, we saw the NBS also come to say that that does not capture the true picture at this time, that it does not capture, the whole impact of removal of subsidy. Well, it is a factor that the MPC, the Monetary Policy Committee, will be considering largely. We have seen South Africa rates have been halted because inflation tapered. We have seen it taper in UK, in the United States. We have not seen it taper in Nigeria. Let's talk to Professor Ochiwaleke now, Professor of Finance and Capital Markets at Nasarawa State University, a regular at our Capital Market program, but now on Business Morning. Prof, good morning.
Yeah, good morning, Ini. My pleasure. Thanks for inviting me.
Good to see you here. Good to see you this morning. So, obviously, inflation would be a major consideration for the MPC as they start their meeting on Monday and conclude on Tuesday. But we've seen rate hikes over almost all through last year. But we haven't seen it have effect on inflation. Would it be wise to continue with this hike of rates, especially when the president has even said that he's looking forward to a single-digit interest rate?
Well, yeah, I think you've made the point. The MPC since May last year has been tightening rates. Of course, the MPC is that of the central bank. Central bank has been tightening rates since May last year, but we've not seen the impact of that significantly on price level. Although, if you read the monetary policy communique of May, you would find there that the central bank was making the argument that if they had not done, what they did, or if there have not been a tightening monetary policy, that inflation rate would have been a lot, much higher. I think they cited the case of the May inflation that came in at, or the previous month, April, came in at 22.2%, and said if it's we aren't for the policy rate hikes, that particular month, inflation rates would have been higher than 30%. So the central bank is saying that they have evidence that inflation pressure is also coming from the demand side. That is not only the supply side, and therefore there was the need for them to, to continue on that path. But in my view, I would say that it's time the central bank paused the rate hikes. Although that signal came during the last MPC when it only increased the MPR by 50 basis points. And even in that meeting, one member was actually voting for a 25 basis point. So I think for the month of July, when they meet next week, I should expect that at least they will maintain the status quo, they will keep the rates. Because the reality, Ini, is that financial conditions are already tight. And against that backdrop, it wouldn't be, again, in the interest of the system to say you are, further tightening. You're also increasing the MPR. And remember, it's not just the MPR we are looking at here. The MPR is one, of course, it represents the anchor. But we also have other instruments that they have also been using to further tighten, and one of which is the capital, reserve requirements. The liquidity ratio is also another. And with particular respect to the CRR, if you compare Nigeria's CRR with the CRR in other economies, especially sub-Saharan Africa, what you would find is that the Nigerian CRR is a bit on the high side at 32.5%, which is why I welcome the idea of reducing the CRR with respect to merchant banks by virtually, I think, around 70%, down to 10%. Of course, what that means is that merchant banks will now be in a stronger position to finance, projects and to also lend to, the real sectors, of the economy. So, by and large, as I said earlier on, there is need to also consider, possibly in this meeting, a further reduction of the CRR for deposits, money banks, to the previous level it was before it was jacked up. In September last year, CRR was 27.5%, and in one fell swoop, the Central Bank of Nigeria, through the MPC, jacked it up by 500 basis points to the current 32.5%. And what that does is that you are, indirectly taxing the banks. You are sterilizing funds because, in effect, CRR is not remunerated by the central bank. Of course, it's a mandatory cash that banks are supposed to provide, keep with the central bank, to act as buffer. But of course, when this ratio is very high, it means that the ability of banks to, lend to the real sector is constrained. And you'll agree with me that in taking decisions, regarding even trying to reduce inflation, there should also be a consideration of output. In the first quarter of 2023, just as we know from the MBS, GDP growth rate, dropped, came down to 2.31%. And I wouldn't be surprised if by the time GDP, the second quarter numbers, come in, we also experience a further decline. So there is need for the central bank to support growth. One way by which they can support growth is to also see how they can ease this, monetary policy. If you look at what is happening across the world now, whether it's the US or Europe or even South Africa, you just mentioned South Africa kept rates, even when inflation rate in South Africa is around 5% within the South African Reserve Bank's long-run target of 6 to 3% and 6% range. So the rates we are still kept at 8.25%. If you go over to the US in June, of course, the US Federal Reserve also paused rate hikes, even when, of course, on the back of a moderating inflation rate. The last time I checked, inflation rate in the US came in at 2.79%. In the UK, there's also plan to at least not to be tightening monetary policy at a very aggressive pace. So what I'm saying is that against this backdrop, it would be nice if this MPC considers, leaving the rates as they are, or better still, reducing the, as I said, the cash reserve ratio, particularly for
reducing that rate and
banks.
Reducing the rate seems like very far-fetched. So let's just maybe pray for, the halt or pause and withholding of it at the rate that it is at this time. Well, Prof. Uche Waleke, Professor of Finance and Capital Market at Nasarawa State, one of our usuals here. Thank you so much for your analysis. And we'll see. Monday, Tuesday is almost here. We'll see what the MPC will do. Enjoy your weekend.
Thank you, Ini.